Thanks again for making the time to join us here today. I thought, in terms of the topic for today's discussion, how junior and mid-miners can access capital, we'd kick off by just asking how you consider the capital market has changed for these junior and mid-market miners in the last little while. Perhaps one of you could make some brief comments on that.
Thanks, Simon. I think we've all seen some of the devastation that's occurred across the capital markets and kind of how capital markets are treating the junior miner space. There's no surprises, even large operating companies are down 90%. So, in terms of how we look at it and those ones that will survive, we feel that the capital markets will consolidate a lot of the industry. That companies, a lot of them that are trading they're trading below their cash balances in many cases. Those will be kind of prime M&A targets that people will then put a few of those together. One of the things where I think that the industry itself is really focused around is the sustainability of the business, the cash burn rates that are going on, and that they're really punishing those companies that are financing their own lifestyles, which unfortunately some of the junior mining space gets a bad reputation around doing. So I think that those with reasonable prospects, near-term production or cash flow visibility, something at least in the headlights, you'll see quite a bit of consolidation of those, and then we're going to see some disappear.
Yoad?
I think just to add to what Thomas said, basically if we look at it from more of an investment perspective, I think over the last few months, at least in some of the segments, depending on the actual commodities, valuation starting to be a bit more attractive, because obviously we're coming off 2 years essentially, or even more, of material downturn, where you had, a lot of people, as Thomas mentioned, a lot of share prices got decimated. So what we have been looking into sort of opportunistically to go and get more exposure into some of the players that we deem are the ones that would be able to survive the next day. People that have, to an extent, a bit more leeway in terms of funding, sitting on good assets, have competent management in place. So we have been starting to nibble for a few of our clients in some of those names. But I think that actually from a capital raising perspective, things continue to be quite challenging for a lot of these players.
Yeah, that's right. I would agree. The market has basically become very selective. Earlier, 3 years ago, you could raise any amount of capital for any sort of project, and today investors have become much more selective. If you want to raise money, you need to have a real proper plan to use the money, not like Blake said, to just finance junior miners' lifestyles, and which is a good development. And you will probably see in the next upturn that the good companies will perform and now provide the leverage to the underlying metal prices that you normally expect. And there's a lot of zombie companies around that are not going bust, but will also not perform because they're so diluted that even if they have a success in a project, it will hardly trickle down to the bottom line for the shareholders. So the key is really to pick those good companies that have survived and have good projects, and seed out the bad ones.
Okay, so I think some of the trends that you've outlined there are the consolidation, the opportunistic nature of the investment, and perhaps the weeding out of those that are not giving full effect or getting the best impact out of the junior project that they may be holding. Just in this quite difficult capital environment, where are you seeing the capital primarily originating from? Are there any particular sources where there is still an appetite for this sort of investment?
I'll just start. Probably Blake and Yoad have a better insight into this. I think there's really still a lack of capital, because private investors are basically either wiped out or they're sitting on their investments and they have no liquidity to average down. A lot of hedge funds are still sitting on the sidelines. There is a lot of capital which has been amassed over the last year for private equity, which is waiting for mining projects. That's interesting. But we haven't really seen fresh inflow of money from fresh sources yet. The selling seems to have stopped last year, which has lifted prices now, but there hasn't really been an influx of fresh money from fresh sources.
And I think that we're quite uniquely positioned here in Singapore for a couple of the key markets in the area, and there's been a lot of chatter over the past 12 to 18 months around Myanmar, and there would certainly be capital available. And I think if you talk to some of the guys at firms like Prime Partners, who kind of dominate the Catalyst board here, there is definitely retail capability within the Catalyst market in Singapore as a new source of capital, which really traditionally has never financed mining stocks before, or mining operations. And because of some of the success on other Myanmar listed companies here, it got a lot of attention to the vast private banking network here and clients that look to Singapore as kind of a safe harbor with good controls, good regulatory environment, which gets superimposed over perhaps a less regulatory environment or a new kind of emerging market like Myanmar. So I think for new sources of capital, the Catalyst board here, I think, will emerge as a new, well-run source, because they're taking a lot of the things that perhaps the Australian stock market and the ASX did and allowed companies just to issue gazillions of shares and raise capital at fractions of a penny, and they're going to move away from that. Take the experience of what happened to a couple of their counters in September, and I think then we'll create a reasonably robust new market to raise capital, particularly for the Southeast Asian region.
Yeah, look, I think another source or pool of capital is essentially the family office type of capital, and you have in Asia quite a few family offices which know the area. They're comfortable with, from a geopolitical perspective, they're comfortable with the risk of places like in Southeast Asia, and they're more receptive to take exposure to certain projects which maybe a couple years ago were not very exciting, but now as valuations materially came off, some of these projects are actually well positioned from the way even that they manage them from a cash flow perspective, but they just lack funding. And in that segment of the market, the more smaller sort of end, where you're looking for smaller tickets in terms of capital raisings, you do see family offices that co-invest in those type of situation. But I think from the company side, you really have to be creative as to how you raise capital. So it's not just straight equity, but just to try to think about structures which would be attractive enough for those investors.
And just on that concept of being creative, are there any sort of new forms of funding or instruments that are being used at this sort of level of the market that may be appropriate for other junior or mid-cap markets, players that you think have been effective?
I mean, just following up on what I was talking about and what Thomas previously mentioned as well, that I think the new investors will demand an incredible larger amount of control than 3 years ago, as what Thomas was mentioning. People were just throwing money at the mining space and just issuing common equity. I think corporates today should expect that the investors will almost take control of the company until the management proves itself that they're on the right track. So I think you'll see a larger amount of convertible bond issuance that protects the investors, at least puts all the previous capital kind of behind them in the capital stack, elevates them a little bit higher. I mean, debt is always a dangerous thing in the junior mining space, but it's more for a control perspective. I think that the new money is worth more than the old money, because the old money was kind of destroyed. And you will see them, put people on the board, maybe instill people in management. So I think, people should expect to have to lose a little bit of that control and not just get the free money that they previously got in the past few years?
I wouldn't say this is a new trend in financing, but just to illustrate how desperate the market had become end of last year, there was one new form of investment coming out of London, the Global Resource Investment Trust, which is not a new concept. It's been done before, but it works perfectly in such times where a market is so starved of capital, where a lot of the really small juniors had absolutely no access to capital. And what they did is they didn't give cash to the companies. They basically swapped paper. They swapped shares in a company for shares in the fund, which then will be listed in London, and that creates the liquidity event for the companies, so they can sell their shares in a fund. It's a genius concept, at least for the asset manager, maybe not so for the companies, but it illustrates how desperate a lot of companies were that they took this deal.
I think at least from what we have seen over the last, say, 6 to 12 months, we saw a few situations where you had people looking for more of bridge financing type of arrangements. So people that have fairly developed projects and they're close to production just need an extra bit of funding, which obviously very difficult for them to go and tap the market. So people were looking for bridge financing type of situations, and this is where, again, some of the private investors, family offices, and some of the small hedge funds that are looking for those opportunistic situations where, if appropriately structured via convertible bond, people are sort of providing kickers in terms of other cash payments or free warrants and so on and so forth. These situations do present sometimes an interesting opportunity from an investor perspective, because you have sort of a base where you can at least get some coupon paid, so there's a cash flow coming in, but you still maintain some of the upside, which is what people are still looking for. No one wants to go into a 12 months sort of exposure and provide the money for 10, 12, 15%.
Perhaps onto a slightly loaded question, but I mean, when you speak to management and even boards of the junior and mid-cap miners, they are continually focused, to my mind, on the right time to raise capital, and whether there's a window or a result or something that may give them a better opportunity. I wonder whether you could comment on whether there is, in fact, a right time to raise capital, and if so, perhaps let us in on when it might be.
I'm not going first.
Thomas?
Yeah, you always know in hindsight when was the right time. I think companies need to be more creative in raising capital going forward, where they're not going to go out and just raise a bunch of capital and load up, because that's not going to work in this market. I've seen a few companies that are already in production. They have a plan to raise money in 3 stages and partially finance out of own cash flow. So that makes a lot of sense. Other companies, junior explorers, there's a lot of them that are completely diluted, and they're now trying to, because they cannot raise capital, they are now bringing in partners and giving up a majority of their projects. But I don't think there's a right time, because a lot of companies 3 years ago could have raised any amount of capital at, let's say, at a 60-cent share price. And some of the good companies actually turned it down because they didn't want to dilute that much. And a year later, they were desperate and had to raise money at 6 cents a share and got diluted.
I mean, I would think if there is a right time, I mean, one of the things, because investors, particularly in the liquid space, have been so beaten up over the past 18 months, that if there is any kind of catalyst within the company that's a kind of a near-term catalyst that something could happen, to raise money before, even though it might be dilutive, have a good positive event and then go back to the market again, because your investors will be kind of feeling certainly better about things. Try to raise a little bit of capital, have a good catalyst, or some kind of material event, raise money again after that. But certainly don't go out and just issue a whole pile of paper at 5-6 cents, and try to stage it, as Thomas was saying.
Perhaps moving to the sort of the types of projects that in this difficult environment are able to attract the limited capital that's around. Are there any in-demand commodities or projects right now? I mean, is there anything that's particularly hot in your view?
Start with, I think, given where a lot of the base metal prices are, people and what people's production costs are, it's certainly shifted people's mindset and views towards some of the things. We see a strong demand out of emerging markets for very, very simple things like cement projects. It's a very simple, basic, boring project. It's not as fancy as building Oyu-Tolgoi or some big project like that. But if you look at, for example, cement in Myanmar, the market is only, they produce about 2 million tons a year. Domestically, they import 10, and that's been their historic average without any of the new construction that's going on. So we've seen both operators and investors very interested to get exposed to that particular space, and almost at any price, because they view it as, cement's a big, heavy bulk commodity. Why are they importing it all from Thailand? It makes a lot more sense to have it domestically. So I think that would be something that probably people didn't really look at before. You kind of thought of never really that much about cement. But I would say the same guys who were very keen on coal and copper 2 years ago are very, very interested in looking at base building materials today. So there's kind of a new trend.
Thomas?
Yeah, I'm more focused on gold and silver, which I don't consider commodities, but more monetary metals. But if you ask me about what's hot, I think maybe nickel might be coming back to life this year because of the situation in Indonesia, and I think there's some more discussions about this during the conference. So that might be maybe the surprise of the year. But otherwise, I don't have any particular comments.
Look, I think although out of favor, actually coal, you mentioned coal, and coal is obviously completely out of favor with most investors, and we have been looking and seeing a few projects which are very interesting, reasonable assets, good sort of stage from a project perspective, and those actually have shown a bit of interest amongst the selective few of people that are thinking that it might be, after 2 years of slump, to go back into the market. And apart from that, I also agree with Thomas in terms of precious metals, that gold, especially after last year's debacle, is coming back to show a bit of interest. And I think if the trend sort of continues from the commodity price perspective, and we've had a pretty good run in gold and silver prices since the beginning of the year, then you might see a bit more further interest for those junior exploration and production in gold. But I think the biggest trend is actually going to be more from on the M&A side, and 2014, where you have a situation of at least the big miners who are do have the financial sources and ability to try and nibble and pinpoint good assets. They might take a crack at doing that.
And just on that M&A potential trend, do you think that would be at a sort of a corporate level, or more likely something that the majors can manage, a project by project sort of proposal or proposition for them?
I would have thought that people would tend more to buy at the asset level rather than go to the hustle of the corporate. So that's sort of my view, where you'll see most of the deals happening.
Perhaps on the flip side, in this cycle for commodities, there are obviously several that have been on the nose for a year or 2 years or even longer. Is there anything that the management or board of a junior who has a solid project or prospect in one of those categories of commodities that are perhaps out of favour in the markets, is there anything that they should be focusing on in terms of maintaining the attractiveness or the potential upside in the future for their projects?
I think one thing that we drill down on quite a bit, I mean, there's a lot of great projects out there. A lot of their cost structures just don't make any sense. So I think if those with really good projects, I mean, the ones that will succeed and the ones that will go forward are the ones that can manage their cost controls much better. I mean, one of the, and I'm sure this happens in this room, there's a lot of guys who live in Perth who run a mining company in the middle of Africa, and their operation costs, because they're flying guys in and out so often, is incredibly high. There's a company, one of the booths here actually, it's a silver company that runs in Mexico, is 100% run by Mexican. There's no guys flying in and out, so their cost basis is incredibly low. So a company like that will be able to bear this kind of storm that we're through. And I think, as you had mentioned, we're kind of seeing some of the bottom of this and the rise, particularly in some of the gold miners. But I think that's the companies that they really need to drill down on cost control. And being able to stick to budgets. We were involved in a large company called Northland Resources, iron ore miner in Sweden, and $400 million to build the mine. The bill comes in at like $900 million. Of course, they're busts, right? And it was guys not being really on top and being able to touch the project every day and kind of running it remotely. So I think that those kind of cost controls, management on site, and less fly in, fly out will draw people's attention and say, hey, these guys are at least trying to do it, and they're all on ground and they're all living there.
We have about 10 minutes before we're due to wrap up this session. I wonder if there are any questions from the floor for any of the panellists. Perhaps if the delegates could give some thought to questions they might have, and I might just press on with one further question from me. We've talked a bit about the management risk that some of these junior and mid-market players have in terms of not effectively managing either their management structure or the cost structure. Are there other particular risks that you think are alarming for capital, that a real focus for capital, and that they're trying to avoid? And if so, is there anything that those sorts of projects can do to bridge the gap? Infrastructure access, the sorts of things that...
Well, I think even to the management, I think what we're going to see is what Yoad was mentioning is also consolidation and M&A around that, where you may see the best of the managements will merge together, and you'll see consolidation around that. Then those companies can be financeable. Some of the other issues are that the projects are so small now, and the market caps are so small that it really doesn't attract institutional capital. So the alternative sources like family offices who can understand and maybe take smaller bite sizes into it, but they will focus on the best of management. And I think you will see some mergers of the best management boards together and manage, and projects that will merge together as well, and then those will actually attract financing.
So track records and
combined track records of different people, and you'll probably see some new firms form around it, and then they'll go and acquire 4 or 5 different projects. It's then large enough that it can attract real capital to it. But in the interim step, I think that the family office capital that invests out of Asia will primarily only invest in Asian projects from our experience. They like to be geographic, they know it, they understand the local risks, they realize the regulatory environment in that particular area. Indonesian families love to invest in Indonesian companies because they don't view the Indonesian risk as the same as some New York fund manager watching CNN, right? So, it's a big different disconnect, and I think you will see more regional capital being raised and less off of Wall Street.
I think about this whole global sort of view where you had maybe a decade of real globalization, especially in the mining sort of sector where it's a very global type of industry. You see some sort of back to basics where people try to focus more on regions that they actually do understand, and they can derive the consequences and the outcomes in those regions. So as Blake said, it's more challenging for, let's say, Asian money to be targeting projects in other parts of the world, in South America, for example. I'm not saying that it's impossible, but it's definitely a bit more challenging. You need to really come with a good story, track record of management. You need to mitigate a lot of those concerns that people have in order to be able to attract money.
I'll just ask if there are any questions from the floor. If you just stick your hand up. We're just going to... Thank you.
Hi, my name is Sergey Shendrov, Magnetic Sand Resources, Philippines. For those junior miners that have enough critical mass to perhaps attract institutional demand in the public markets, do you consider listing a viable funding strategy relative to the alternatives for most of the projects out of Southeast Asia that are big enough to attract enough liquidity, and where would you see them list? And how do you rationalize in the current environment for people to actually go to public markets, given the valuations, given the regulatory burden, and potentially availability of alternative sources of funds?
I mean, I really believe in the concept of domestic capital funds, domestic projects, probably the best. And a Philippine mining asset or oil and gas asset, probably at the junior level, probably should be listed in Manila, because I think you're going to attract more people who understand the risks and everything else. I realize that, and somebody from the TSX is probably here, I think they have 60% of the world's miners are listed on the Toronto Stock Exchange, but there's a lot of people in Toronto who don't really understand, the local dynamics of the Philippines versus Indonesia versus Thailand. And I would think that, listing first in your home country probably will attract the greatest valuations, because you're not going to get discounted, because again, the CNN factor of somebody who will just equate the Philippines to Malaysia or something and do not really understand the differences. So I would look at if it's a good quality asset, starting that discussion. I think the Catalyst Board in Singapore will play a regional role. And I think particularly for countries like Myanmar, being a public company is a nightmare, though. You got to realize that there's a lot of regulatory environment, there's reporting and everything else. And I think that those companies who have, and the costs of listing as well, I think a lot of those companies that remain private over the past 18 months are very, very happy that they did remain private, because they, I can at least try to argue their valuation, as opposed to the market, which has argued that it's down 95%. Right? So I think that being public is not necessarily the all-win strategy, but if there is a decent following locally, I would look at the local markets.
I think adding to what Blake said, I think the challenge for a lot of these companies when it comes to exchanges around Asia is exactly at what stage a company is. Because if you're a junior guy and you don't have cash flow, there would be a challenge for you to list on a few of the exchanges. Whereas still places like Australia, places like Canada, the AIM and London for certain focused companies is probably more of a natural habitat, because people are more used to sort of getting their pure exploration companies that don't have any cash flows. So I think it really has to do with at which stage you're at from your sort of progress and company perspective.
Maybe just adding to that one more, is that it's very, very true that in the Asian exchanges, people look to earnings. And, I'm going to guess 90% of the companies that present here today don't have any earnings. And that the typical person who's buying in the local exchanges here can't understand that the company has earnings, but it has a multi-billion-dollar market cap. I mean, when I was at Ivanhoe, our market cap was $18 billion. We didn't really have any substantive earnings. So you're trading at, almost like a tech company. It's unbelievable. So I think that is the one local nuance that people have trouble to get over. And places like Hong Kong, you cannot list if you don't have earnings. So they're not really welcome to the exploration companies.
Thanks, Blake. Are there any other questions from the floor? Probably got time for one or two. Just in front here.
You were mentioning that there are junior miners who are financially capable, could be viable. Then local capital should drive the local investments. That's what was the gist of your point. But what about illiquid markets like Mongolian Stock Exchange? It's very illiquid. But there could be a lot of viable projects like gold deposits which could be easily exploited. In that case, then how does one balance that with the other argument that global exchanges, for example, most of the companies in Mongolia are listed on Toronto, and many people may not be aware of the local risks, or they might not even understand the project. In that sense, how do you balance that? Illiquid markets versus financing needs versus global market understanding. How do you balance the three? I would be interested in knowing that.
You point out a very good point around liquidity around the markets. I mean, the day chairman, Travis, is the most exposed person to Mongolia in this room, I think. So it's very valid. I think those companies don't go public. I mean, the companies in Mongolia, unless they are big enough, shouldn't be public at all. And they're funded with private equity until such time that the political situation in Mongolia resolves itself and it will attract capital. I mean, 3 years ago, you could raise $1 gazillion from Mongolia just by throwing any project out there. Look how quick it changed. But that's not that the projects aren't viable or that people did not. It was government driven and regulatory driven around why people just turn. And that shows also the speed of global capital, that if it will, the global capital will also punish kind of bad behavior, whether that's at the company level or whether it's at the country level. So I think, again, being public isn't the best solution for probably 90% of the companies. Being a private company and then doing an M&A sale at a valuation that you can kind of support with kind of proper underwriting might be a lot easier than being in a liquid stock that you can never sell, but with all the regulatory overhang of being public.
Maybe one way to bridge the gap would be if you want to list and you cannot list in a local exchange because it's non-existent or too illiquid, you would list in, let's say, in Toronto or Australia, but make sure that you have 1 or 2 or 3 local major shareholders as an anchor shareholder who provide some confidence to the market and also hold a substantial share of the outstanding equity.
Are there any other questions? If not, I might just ask one final one, and it's really just to follow up on this, the very sensible point you've made about regional capital being attracted to regional projects. For those that do have projects that are outside of perhaps the immediate region, be it African or South American or otherwise, but they do need, for whatever reason at the time of their development, to access the Asian capital, is there anything that they can do to try and address those concerns or the uncertainty about the regional issues?
I think that one of the things in the, let's call, outside of the Asian region, so projects, as you said, in South America, if there is an angle to Asia, there's a big offtake agreement with some Chinese company, or there's something like that, I think then you can make the argument that, hey, this is really linked to China, or it's linked, to one of the other countries, and that there's offtake agreements in place, and it doesn't really matter where the mine is, because really the credit risk is the offtake agreement, and the offtake agreement is with, Chinalco or somebody like that. So I think that's one way in order to kind of package your project from, say, if it's an African mining project or something like that, and how would you kind of, tap that Asian capital. I think that having a link back to Asia certainly helps.
Any final questions for our panellists? Given us a lot of insights today, so perhaps I would just take the chance to thank each of you, Thomas, Blake and Yoad, for your insights today. I think it's been incredibly valuable. It doesn't necessarily paint a rosy picture for junior or mid-caps, but that is the reality in which we live, and I think the points you've made just crystallise in people's minds that we need to be more creative, more focused on the issues that are going to ultimately deliver value, and perhaps think more carefully about the type of capital that we're trying to attract. So could you please join me in thanking each of our panellists today?